Let's return to Jonathan Sheridan at FIG. We're having some audio issues, re-establishing contact. Jonathan, since we were speaking, of course, we can perhaps just move the discussion forward into these minutes from the Reserve Bank. Again, reiterating a significant amount of stimulus is already in place to support the economy. Does that speak to you of a Reserve Bank that is poised to ease further sometime soon?
Yes, good to have you back, Carson. I think probably not, to be honest. I think that they have said there's a high hurdle rate for any change, either from an easing perspective or a tightening perspective. I think that they see that they've got a significant amount of stimulus in place at the moment, and whilst the economy is picking up gradually, they're obviously still concerned about various issues, including in the main the movement from the mining investment to the non-mining sectors, and looking for the non-mining sectors to pick up. But I think that they think the policy settlements are appropriate for what we've got at the moment, and there'll have to be a material downwards move in the data that we see before they might make that easing.
What changes when you look at labour costs that are subdued and retail sales and consumption easing? This is a critical part for growth, slides of growth in the economy. How do you change that when in the next breath you say productivity is improved across the economy?
Yeah, look, and that's why I wouldn't want to be a central banker, to be honest. I mean, I think it's difficult. You've got all these different data points that are coming out that are very mixed, and I think they try and look through them and look at the overall strength of the economy. So, like I said, I think that they're quite happy with where we are. I also think potentially that, given what's happening in the global economy, they'd like to keep a few bullets in the gun if something major happens offshore. We saw one of the largest banks in Portugal basically default this week. Their equity's off about 80% in the last 3 months, which is a reflection of what the market thinks of that particular business. And we've seen those government bond yields in Portugal spike about 40 basis points this week, albeit, off a massive recovery or a massive tightening this year so far. So I think that they would like to see some real strength and headway in our economy, but they'd like to, keep some powder dry if they need to do something as a result of a global shock.
A brief final thought on the FSI, the interim findings. It looks as if you, net, are not delighted with the response from Murray today. Why not?
Yeah, I just think personally that there's some pretty simple things that they could do to open up the bond market to a much greater participation from investors. I think there's some taxation implications that need to be looked at, and that's a broader picture, but I think the taxation situation in Australia favours risk assets, particularly with the transition to retirement that we will be expecting self-funded retirees to go into over the next 10 years or so. I think that's something that needs to be looked at, and talking about negative gearing, franking credits for examples there, and also there's this wholesale certification, which means that you have to control a lot of assets or have a lot of income before you can access bonds, and that's the majority of the bond market. So I think you can buy risky shares with no restrictions whatsoever, but you can't buy safer bonds. I think that's a bit of a nonsense piece of legislation. Yeah,
two classes of investors, I suppose, it creates at the end of the day, doesn't it? Not necessarily on the same level playing field. Jonathan, thank you so much. Jonathan Sheridan there, Associate Director, Fixed Income Sales at FIG. Overseas now, William Hague.